Well, our next guest sees loan defaults creating more turmoil in the economy. Let's bring in Lindsey Piegza, Stifel's chief economist. Lindsey, great to have you with us.
Thanks for having me.
So recent data has been not bad. Retail sales, the last jobs report, but you say this is not a good reflection of where we are. Where are we then?
Well, I do think that the data is a step in the right direction, but it reflects more of a temporary improvement. Consumers were pent up, facing an extreme amount of pent up demand. And so we did see this binge in May after an equally downsized disappointment in April. But when we look at where we are from a longer term perspective, consumption is still down 8% from those pre-pandemic levels in January. And on the labor side, yes, we did add surprisingly 2 million jobs in the latest report, but on net, we're still talking about a loss of 20 million. So these are tiny steps in the right direction, suggesting that we've moved into sort of the second phase of this three-phase pathway to recovery. Starting at the initial stages of that deep decline, we've moved now to the bounce. But to get to a longer-term sustainable pathway to recovery, it's going to be very slow, very bumpy, and quite a ways before we can talk about a sustainable improvement in the growth rate.
As an economist, I'm curious, Lindsey, at what point in time do you think you will get the data points that reflect the true state of the consumer and the economy? Is it a month? Is it 3 months? Is it 2 quarters?
I do think the data right now reflects the true state of the consumer, but it's very volatile. And the consumer is in a very volatile state, very dramatically shifting their spending patterns month to month. This isn't something that we normally see, but it reflects the chaotic nature of the consumer at this point. But I think really what you're getting to is, when do we see more stable data points to get a better sense of the underlying trend? And I don't think we're going to get that until closer to the end of the year, or we turn the calendar page into 2021 and we start to see some stability in the economy, and we start to get some stability in terms of the labor market as businesses reopen back to a more normal level of capacity in the marketplace. Right now, we're still talking about some businesses reopening, some waiting until the restrictions change from 25 to 50 to a full 100% capacity. So there still is a lot of volatility in terms of how businesses and how business is going to function in the marketplace. So I don't think we're going to see that true level of calming trend until sometime at the end of the year or next.
In terms of loan exposure, Lindsey, I'm curious as to how you take a look at this figure of 100 million loans that aren't being paid in the latest month, and also what the ripple effects of that are. I mean, what was interesting in this Wall Street Journal article that brought this whole thing up is that they noted that in doing a credit score, missed payments are noted and are factored in, but not loans that are in deferral of some sort. And so, a bank or a lender taking a look at the state of a consumer right now may not be getting the full picture. And I ask you this knowing that you're a former mortgage analyst, so you might have some insight on this.
Well, I think there's actually two diverging themes in what we're seeing in terms of the consumer sector right now. On the one hand, there are millions of Americans that are skipping payments, particularly when it comes to student loans, auto loans. And this is reflecting both increasingly favorable terms in terms of the debt holders. So those debt holders allowing the consumer to skip those payments. But it's also reflecting very reduced financial conditions in terms of both the individual and the household. Remember, the pandemic has left millions of businesses and workers displaced. On the other hand, we're also seeing Americans pay down debt at this point, particularly credit card debt. Now, this is more a reflection of reduced expenditures. So we have been in lockdown for the past several months, but it's also a reflection of access to increased income. So we're seeing very favorable unemployment benefits, stimulus checks, other government programs, and some Americans have actually benefited from this, and they're taking that opportunity to pay down debt levels. So we're seeing two very different themes when it comes to the debt market. Some may actually emerge from the pandemic in stronger financial footing, while others may face increased financial ruin.
All right. Lindsey, great to speak with you. Thank you.
Thank you.
Lindsey Piegza of Stifel. Karen, especially as the banks are preparing for the stress test next week, how do you view how they're going to do in those tests, and whether or not there might be extra stresses put on them in this process this time around?
Well, I think there's, the stress tests were obviously put in place post 2008 crisis for terrible scenarios, and we actually are in one. However, sort of ironic, I think, if ever the stress tests were to give banks a little more room and be just a little easier graders, that would be now, because they really want those banks to just keep functioning. So I don't know. We talked yesterday about the idea of, would J.P. Morgan have a dividend cut as might be priced into their options? I really don't think so. I think we're going to see. Good marks almost across the board in the stress test. I hope that helps bank equities.
All right. We got a big call on Tesla today. Jefferies upping its price target to $1,200 a share. That's a new street high. Analysts say the COVID crisis is accelerating demand for electric vehicles. They also know Tesla continues to lead its peers in product range, capacity, and technology. Tesla gaining more than 1% today. And it's interesting to see, some of the other EV makers, stocks trade up in today's session. NIO, for instance, the Chinese equivalent, if you will, traded, I believe it was an all-time high on record volume. Guy.
Yeah. And listen, again, for the 100th time, I'll say that Tesla befuddles me, and I understand it, that a lot of people get it and I don't. But what I have said over the last, month or so is the comments I made going back to the president's interview with Joe Kernan in January, when, basically brought up Elon Musk. And ever since that point, the stock's only gone higher. And for further proof in terms of how impervious the stock is, it's $700 at the end of May. Elon Musk basically said the stock is too expensive. I'm paraphrasing. That lasted for about a day. And now here we are, some 43% or so higher. So it's clear that the trajectory of the stock is higher. And that's the way you have to play it. It'll do it without me, and it's done that for quite some time, but it doesn't mean the folks at home shouldn't still be in it.
Grasso, you're a believer in the bridge to the other side. You're a believer of the Fed liquidity. So is this one of these trades where you just hop on board and enjoy the ride?
Yeah, I think you have to hop on board and enjoy the ride. I'm a little concerned over the nosebleed territory, but you could have said that all the way from the price where they raised money. I think that was $767 or thereabouts. The stock, its ability to work off overbought on an RSI is phenomenal. If I look at the chart now, it was overbought at 1,025, traded down to 990 and worked off the overbought status. It's no longer overbought, even when you look at the chart where it is now. Remember, it had a head start. So we were talking about all these names pre-pandemic. We talked about all the competition. Talked about Ford, talked about GM, talked about BMW. But all of those car companies took a stutter step. And if anything, Tesla has been keeping at it while the other ones are making face masks and inhalers. What you have now is Tesla has spread the gap between them and Tesla. So I think you kind of ride this one out. Look for support in the name. It's obviously around the 20-day moving average is 900. So you have a lot of room between here and then, but that's your exit strategy in Tesla. Keep playing it higher and play it for a 900 exit on the way down.